An important aspect of the investment landscape in Africa for private equity investors are development finance institutions. They offer access to capital which is not always forthcoming in the region. Roderick Everson of CDC Group chaired a panel of some of the biggest development finance institutions in the world that are active in Africa, discussing their perspectives and priorities for the African market, as well as their requirements for prospective investors from the private equity industry.
I was somewhat nervous about the title of this session because super LPs and then with DFIs in the same title. I mean, go back a couple of years, if we were all here in 2007, the title of this spot would have been something like DFIs, super pain in the arse. Why don't you get out of the way and let us get on with investing? But, straightened times, here you all are, here we are, talking about Africa, and of course...
Like now.
But so what differentiates DFIs? Well, look, the key thing, of course, is that DFIs are investors, and we've got 4 investors lined up here who are keen to talk to you about their knowledge and their, maybe their war stories. We'll see. But that is a very important theme. That lots of people who've got a lot of money are very happy to talk, but at least this panel here are active and they're focused on the market. Martin, I'm wondering in these difficult times what advice you would give to African GPs who are thinking about raising a fund in 2010.
Okay, well, it's a good place to start, and I to take things back to basics would be my basic theme in answering that, and I would say simply that we're not really here as investors in GPs just to invest in GPs. The ultimate thing we're trying to do, I suppose, is get down to the businesses underneath the GPs and make sure that the GP makes good choices and invests in good businesses which do all the things that they're supposed to do. But I pick on that point particularly just to emphasize that as a potential investor looking at business plans coming in for 2010 and trying to make selections, what I am really interested in seeing, I suppose, is what is the quality of the business case that the GP is presenting in the markets and in the businesses that he believes he should be investing in. And I would, I guess, take issue a little bit with a comment from the previous panel in terms of the idea of falling in love with a GP. I think that's absolutely not what you want to be doing. That would be a very nice result after 5 years or 10 years of a relationship with the GP. I think, to be fair to the panelists, I think I understand the context in which that comment was made. I think he means you might fall in love with the GP because you're so bowled over by the compelling business case he puts to you. If that was the meaning, then that's fine. But I would rather look through the GP and understand why he believes that the business case for his markets is so strong and fall in love with him on that basis rather than anything else. And I think I would encourage GPs to present cases using as much data as possible, using the research that's available. Okay, we all know Africa has relatively limited data availability and research with which to present such a case, but it is improving. There is more research coming out, and it can help to bolster the case you put to a potential investor, such as the African Development Bank. I would also say, and these are things that you've probably heard before, I would say keep it simple. Complexity, I think, can make things difficult to understand. Try and present a differentiated case. Try and present something which doesn't look like the other 25, 30, 35, 40 plans which we will see in the first 6 months of 2010. And these are, I think there's possibly a fondness for presenting the focusing on things like the structure of the fund and focusing on things like the remuneration of the fund manager. At the end of the day, if we have 25 plans that look identical, it doesn't help anybody. So I'd say try and be specific, try and present the underlying business case clearly, and then you have a good chance of really cutting through the other approaches that are being looked at. Target your investors. Don't simply send out an email to 500 different possible investors. And I think finally, just be patient. It's a difficult time to raise funds. It will be a difficult time through 2010. If you're planning a close in 2010 and you haven't yet gone on the road, that's probably very ambitious.
Yeah, and I think certainly one of the challenges we're seeing is indeed don't waste our time. Try to make sure we back people who are indeed going to close, and that's a key thing. David, IFC has been in this space for probably longer than any of us. You've got a lot of experience, mainly positive, I'm sure some negative, but why does IFC back private equity funds? And can you tell us a little bit about your experience, positive and negative?
Well, why we back funds in general? We try to use funds where they complement IFC's direct investment business. IFC's total business is 75% debt, 25% equity. Of the equity, we do about 25% through funds. And really what we're trying to do is complement spaces where we can't act directly. So IFC, for scale reasons, has trouble doing SMEs, for example. Also pushing up towards the frontier. So we've got a partnership with business partners in South Africa to go out into Madagascar, Kenya, a number of other countries. And they're really doing very small business investment, which is something we have difficulty with. But if you look at the funds themselves, we're about achieving development impact and achieving commercial proof of concept, so that once the commercial money really starts to come in, we move out. And we've done that with a number of funds. I mean, in Brazil, we were an early backer of GP Investimentos. In China, CDH, Advent globally. We've moved out of all their funds now because they're attracting enough money they don't need us anymore. So what we're really looking for are fund managers who can add value to the companies, because most of this is a growth game in emerging markets. So people who can bring both the advice and the hand-holding that fast-growing companies need, and the capital, to create the next generation of leading companies in those markets, and also create a lot of jobs while they're about it. So we think private equity, because it brings both the technical skill and the capital, I think it's a very powerful combination for development.
Holger, DEG, you're quite particular. What types of funds and what investment strategies do you like to look for?
I would maybe just jump back to the discussion that we had earlier when we talked about SME funds and what sort of issues come out of that. And I think along those lines, one of the critical issues for us can be well expressed, which is we are looking for commercially viable funds. So we are very cautious on funds that from the outset would have a large element of, well, keeping fingers crossed and it'll be okay, against huge expected developmental rewards. Now, this sounds a bit more drastic than it comes down to in real life, but I mean, we very closely look at the quality of the team, the proposition, very much with private sector discipline, because ultimately, and I think David had mentioned the point, proof of concept. We want to contribute to propositions that can raise commercial funding. And at the end of the day, once our investment runs out, because invariably we will move on once the fund, say, comes to a second or third round, we want that company and that fund management team to be able to stand on their own feet. And we find that is much better done if you start out with that sort of rigorous in your analysis than otherwise. Generally, in Africa, we look more at regional funds, probably with the exception of South Africa. Other than that, we found that most single-country funds do narrow themselves quite strongly. Similarly, sector funds we have been very selective on, actually across the board, not only in Africa, but across emerging markets. We have not really done that much in terms of sector-themed funds. We're now looking at some sector-themed funds around the climate change themes, so clean tech funds, but that's mainly Asia. We haven't seen that many propositions in Africa along those lines. What we do see and what we do look at in Africa specifically is agriculture as well as health. We last year invested in a healthcare fund together with the IFC and the Gates Foundation, but that probably would be in the universe of funds that we would normally be looking at, probably towards the outer fringes of what we consider to be financeable, at least by our funds, because there is, I think it's a very important theme that we are backing there. It does have quite some risks around first-time fund and the sector focus that come with that. Now, there's some soft money to back this up, but this would be one of the more exceptional cases that we have invested in.
At this point in time, 135 African funds are looking for funds, according to MPA, 135. So one of the things we actually at FMO are advising is distinguish yourself. And that can be either in investment size, can be in sector focus. We actually do like that, although we see the return problem, or it can be regional focus. Beforehand, we also discussed the questions, and the question actually was, did the credit crunch affect FMO or DFIs? And of course, the obvious answer would be to tell you all, no, not at all. DFIs, we are counter-cyclical, so we're actually going to put more money on the table. Well, the reality is not completely like that. Last year, 2008, we probably had a record in terms of volumes. On the private equity side, we invested more than $300 million across the world. This year, we will be happy if that number will be 250 million. So something apparently has changed. And I cannot speak for, well, certainly not for David, but for FMO, we were affected actually in three ways. And not everything is purely private equity related. First of all, FMO, as a PPP, public-private partnership, we fund ourselves on the international capital markets. Yes, we do have a AAA, but people who know the market, and all of you probably do, even AAA organizations had to pay up. So our cost of funds increased tremendously. Regretfully, we have to pass that through to our clients. On the debt side, but also obviously on the equity side, more or less. The second thing is our income this year will tremendously decrease. That actually, for the majority, will be related to private equity. When the last year, you probably saw our annual report, we had just income from equity exits of over $120 million. This year, we will be happy if this will be 25%. So also there, yes, we will be affected, and it is actually on the PE side. And the third one is actually more important on the origination side. We, like many DFIs, our portfolio quality does suffer as well. And at the beginning of the year, we said to all our investment officers, to all our commercial people, priority is look at your clients right now, make sure that they're fine, support them, and only second instant look for new clients. Well, that is one of the reasons why probably at this point in time, certainly at the beginning of the year, the pipeline was relatively limited, or more limited than in the past.